Hey there, macro folks. This is Mr. Hooker, and this is Money, Banking, and the Federal Reserve System, video number 3. So here we are, money multiplier in reality. So the monetary base is the sum of currency in circulation in the bank reserves. So monetary base is different from the money supply in two ways. So bank reserves, which are part of the monetary base, aren't part of the money supply, and checkable bank deposits, which are part of the money supply, aren't part of the monetary base. So there's your little Venn diagram there on the right, which shows how all this works. That currency of circulation is there in both of them. The money supply is the big circle, the monetary base is the small circle. It is your bank reserves plus your currency in circulation. Money supply is your checkable bank deposits and currency in circulation. So there you go. That is where we are. Um, so the money multiplier, the ratio of the money supply to the monetary base. Before the financial crisis of '08, it was 1 to 6. After the crisis, it was point seven, it was 1.6. After that, it was 0.7. The minimum reserve ratio, um, and that's a little off too. The reserve ratios were 10, 3, and 0. So like it was 10% over a certain level, 3% for small banks, and 0 for really small banks. So for medium-sized banks, it was 3, and then 0 for that. Um, so why is the money multiplier not 1 over zero point 0.1 or 10? Because people hold cash. So some people, I mean, there's a lot of us that walk around with almost no cash, but then there are some people that hold a significant amount of cash. So I used to live down in southern Georgia, almost at the Florida line. So we were right on the Okefenokee Swamp. And there were people in that area that literally had mattresses full of cash. Um, it was bad. Like the number of people who had mattresses full of cash, and people in the area knew who had mattresses with cash. Um, and you'd see them walking, you'd see them like messing with these people with their mattresses. It was really weird. Um, so the the Federal Reserve System is our central bank. So for any of you that have seen or heard of Hamilton, the musical, Alexander Hamilton was the very first ever Secretary of the Treasury on the $10 bill. His goal in life was to create the national bank. And he did. He created the very first national bank. It failed miserably. What nobody at that time in that time in history wanted to put money in a national bank. This whole country, ladies and gentlemen, was built on the idea of states' rights. Nobody trusted the nation. Like if you ask people, "What are you?" They just said, "I'm an Iowan." Like I'm a Georgian. I'm a South Carolinian. I'm whatever. I'm a Delawarean. Whatever the heck Delaware people are. They would not have said, "I'm an American." They were whatever they were from their state, right? That's who they were. They identified as people from their state. So this idea of a national bank just did not fly to them. Nobody put their money in it. It just did not go. So that one failed. Then they went and they created the second national bank, and really the biggest thing that gave us was one of the greatest Supreme Court cases ever, Marbury versus Madison, where the state of Maryland was charging um, the second national bank something like $50 per officer in the late 1800s. So, like for every officer they had in the state of Maryland, they were getting charged $50 in the late 1800s. So, and that's per month. So you're paying 100 to $150 a month to the state of Maryland. And so, um, Government says, "Nah, we ain't gonna pay that." Well, we have, we are supreme to the state. We not paying you money, and they won. And that, that created what is known as the supremacy clause. The federal government is supreme over states. Yada yada. And then um, we had the Knickerbocker Trust disaster, which was a bank run in New York City. Um, and, JP Morgan bailed out the entire New York City banking industry. And so they decided that they needed to do something. So they sent a bunch of bankers and other financial experts down to Jekyll Island in Georgia, down near where I used to live when I just said that I used to live in South Georgia, about an hour away from that. There's Jekyll Island and St. Simon's, I believe is the other one. Um, they went down there, nice little place to go for a vacation. And these guys designed what is now known as the Federal Reserve System. It is a decentralized central bank. So everybody has their own little region that they work with. And then you have a board of directors in DC. So that's how we go with that now. And if you look at the the districts, um, they're more toward the East Coast because that's where the population was in 1913, where this was done. The crazy thing is, there's two of them in Kansas. I mean, in Missouri. Um, was that like 5, 6 hours apart? One in St. Louis, one in Kansas City. It's just kind of nuts. So here they all are. Um, so we are right there in District 7, but you can see it here. You start up in New England with Boston at 1, New York at 2, Philly at 3, and then you kind of got to go over to Cleveland at 4, come back to Richmond at 5, Atlanta at 6, move left, go up. Chicago at 7, St. Louis at 8, go over and up, Minneapolis at 9, KC at 10, Dallas at 11, and then go way over to San Francisco at 12. They will never change the districts. They'll just change uh, where the regional offices are. So Chicago, we are 7. Chicago, yeah, because I don't think it comes in us. Yeah, so all of Iowa. It looks like all of Iowa is in 7. So um, that's us. So that seems pretty simple. We're in that one. Um, so the Board of Governors, they're in DC. Um, and then the regional Federal Reserve banks. Board of Governors are chosen by the president, confirmed by the Senate. These guys and gals, get one 14-year term. So they can serve one 14-year term and a partial term of somebody else if somebody resigns in the middle of their term. So this is how Alan Greenspan served for 27 years. Somebody resigned 1 year into their term, and that guy, sorry about that, nothing like being live. So the whole thing with Alan Greenspan, somebody resigned about a year into theirs. He served for 27 years, served the 13 years, and then his own 14-year term. Um, and right now you've got the whole thing with Trump not liking Jerome Powell, who he appointed to the Federal Reserve Board, um, and appointed as chair in his first term. And now they're on the outs. So he wants to get him out as chair, which that's a 4-year commitment. So chair is appointed once every 4 year, once again appointed by the president, confirmed by the Senate. So you understand with the board of governors, there's a lot of appointed by the president, confirmed by the Senate gamesmanship there. But yeah, he's not happy with him right now. So he wants to appoint somebody he likes to one of the open seats on the board and appoint them as chair. And that'll come up in May, I think it is. I think it's May. That'll happen. It'll be what it is. Whoever he appoints, he probably won't be happy with them either because they have a lot of freedom. Um, like once you appoint them, you may think they'll do what you want them to do, but they got a lot of freedom once they're there. They can just look at you and go, "Yeah, no, not really. Not really going to do that. Have a nice day. See you later." Or not, not coming to your house. And that's really what Powell did to him. That's really what he ticked him off about Powell. Powell did that to him in his first term. He called him to the White House a couple of times, and Powell's like, "Yeah, I ain't coming." And so that ticked him off. Um, so each Federal Reserve Bank serves a certain region, and that's one of the cool things about the way that works too. So each one, instead of trying to maximize the U.S. economy, tries to maximize its regional economy. So each one is responsible for the economy in its region, and that's it. And so we go with the idea that by maximizing the economy in your region, if all 12 do that, then we will have maximized the U.S. economy. So that's the idea behind it. So these three tools are wrong. Just saying, we don't use any, well, we use one of these three tools, but these are not the tools of the Federal Reserve anymore. But reserve requirements, discount rate, open market operations, those are going to be the tools you need to know for the book and the exam, yada yada. I apologize. It is what it is. We'll talk about the real ones here in a minute. So the Fed sets a minimum reserve ratio requirement. Not anymore, it's 0. If the bank can't meet the Fed's reserve requirement, it can borrow reserves at the federal funds market. And that the federal funds rate is the policy rate for the Fed nowadays. So the federal funds rate is the interest rate between member banks. So if a bank, let's say Farmers and Merchants Trust, Bank and Trust needs to borrow from bank, right? Um, or needs money at the end of the day. So then they can make a call to bank and say, "Hey, y'all have any extra funds on hand?" They say, "Yeah, we do." So like, okay, we'd like to make an overnight loan. So they'll just write it. They'll write up something, fax it down to bank. Bank will do their little thing and fax it back. And it basically will state that Farmers and Merchants has access to however much they've said from bank for one night plus interest. Whatever the federal funds rate is, the next day Farmers and Merchants will send them that money plus interest the next morning. So they don't do anything that night, but the next morning the money is sent there. Um, and if there's something that happens, um, the next morning, if the FDIC shows up or a regulator shows up, then that note serves as the notice that, hey, we have our accounts covered, we have enough money to cover our obligations, and this is how we're covered. Um, Banks can also borrow from the Fed via the discount window, but that's like borrowing from a pawn shop. Like the Fed is gangster in this way. So basically, what they do is you have to pay all of your interest up front for the entire loan. Like if you go to borrow from the Fed, which I always found weird, it's like, hey, you ain't borrowing from the Fed if you in good shape. You broke. Like if you had any way to borrow from a friend, you'd borrow from a friend. But no, I'm borrowing from the Fed, which means I am supremely broke. And now they're going to charge me the interest for the entire loan, not the first month, not the first quarter, for the entire loan. I got to pay that up front. If I had that money, I wouldn't be borrowing from the Fed. So that's basically it. And they charge them the discount rate. So it's called discounting because of the way that they pay the interest. And so that's what it is. All right. So those monetary policy tools outlined on that last slide are way outdated. This video right here, the Fed explains, is a video from the Federal Reserve explaining the current tools. If you want to know what's up to date, I highly encourage you to watch this video, especially if you are a business major or economics major, anything in that field. So here you go. Please watch this video. I will see you in the next video.